We're live, ladies and gentlemen. You once again welcome to the King Dems Podcast. And today I have with me a very, very important guest, all the way from the other side of the pond. Please be welcome with me, Ken LaCroix. How are you, Ken?
I'm good this morning. How are you?
I am good, but then I am not in the morning. I am in the afternoon. London, England. Where are you in the US?
I'm in Southern California, all the way on the other side of the United States. So, Newport Beach.
Wow, California. Wow, I guess the weather is good over there.
Always, always. We have good weather,
Uh,
terrible taxes, and terrible traffic. So there you have it.
or yeah, you can't have it all in life.
Nope, no,
Something
no.
has got to give.
That's right. That's right.
Something has got to give. I always tell people something. Gratitude is good attitude, and I am very, very big on gratitude. So I am very grateful to you for taking your time out to spend your time on the podcast today, and of course to help us to benefit from your wealth of knowledge and your wealth of experience. I do not take that lightly. I don't take that for granted. So I am very, very grateful to you. But they say the SI unit of measuring life is time. And of course, if somebody shares their time with you, they're sharing their life with you. So love and respect to you for sharing your time and your life with me and my audience today on the podcast. God bless you. So
Thank you. Thank you. Pleased to do so. We have a corollary, more about abundance, less about scarcity. So we like to share the abundance. So thank you for the opportunity.
thank you very much. You're always welcome. You and I share, very, very common, what I say, common points, especially when it comes to finance. I like to call myself the numbers guy, I crunch numbers for a living. And of course, you crunch numbers really then. And of course, beyond the numbers, you also make an impact. Now, the theme of this sport is unlocking financial clarity and business growth with data-driven strategies, right? So we intend to provide our audience with an educative, inspiring, and actionable financial insights for business owners, helping them to grow from gut instinct to data-driven decision making while uncovering hidden profits. So, Ken, you've spent over 20 years of your life helping businesses turn financial data into strategic growth. So, what inspired you to become a fractional CFO?
Well, it's been a journey. After I got my CPA experience here in the States, it's a CPA, not a chartered accountant.
You are a CPA, I am an ACA,
There
but
you
then
go.
we do
Exactly.
the same thing. We do the same
Exactly.
thing.
Just
But
one of the
what is
letters
that
away.
pivotal moment that changed, your approach to uh the finance game?
Yeah. So after spending 2 years getting my CPA experience, I went into the private sector. I was much more of a management accountant than a public accountant. I really enjoy the management side of things. The public side is
Oh,
great. It's a great place to get
it means
trained.
you and me are loggerhead. You guys are always angry about us.
Yes,
I've been a big four auditor, and I see you guys. The way you're
100%.
always upset anytime we're in your office. It just looks like, when are you guys leaving?
Yep. Yep. We're the anti-accountants, if you will. We're the anti-auditors. We're 80/20. You guys are 100%. So no, I just always gravitated towards my cost accounting classes and all of
Mm,
that. So I went to work for a series of companies, usually 5 to 7 years, helping them grow. They were small companies with scarce resources, helping them grow, moving through the different fence posts that businesses have. 1 million in sales, 5 million in sales, 10 million in sales, 25 million in sales, eventually getting a good outcome. Then the financial crisis hit, and the last company that I sold, participated in the sale of, off to private equity, a medical device company. They were moving into the 150 million, 250 million, 500 million dollar space, and that's not my specialty. My specialty is really helping business owners, helping my at the time helping my employers move from 5 million to 25 million to 50 million. That's my sweet spot, where we're putting infrastructure in place. Once the companies get larger, it's harder to make as much of an impact in terms of
mhm.
finance. So in 2009, there wasn't much employment opportunity. I'd always wanted to do consulting. My MBA, I just finished my MBA work, and
Wow.
I said, I'm gonna hang my shingle out as this sort of fractional CFO. I did it here in Northern County, California, and I was one of the first ones to do that, and it sort of fit my style. I like to tell people that I'm your best controller at the time or your best, I love to get in and fix things, improve things, make things better. I have a tremendous curiosity. But once you make me do the same thing over and over and over again, which is the definition of a very good controller or a very good person in accounting, that's where I get a little bit bored. I get a little bit out of my element and it's harder for me to motivate. So I'm always looking for the next thing, the next improvement. So the ability to do that with a number of different clients was very appealing to me. And then as an employee, sometimes you're reticent to give bad news because if your employer doesn't take it well, you could be out of a job. And there's so much that happens in finance and accounting that has bad news as well as good news, or less than good results as well as good results. There's no side of the tail of the distribution that predetermines it's all going to be good news. And so I realized that if I had a number of different clients, if I reduced my concentration risk of clients, then I could be completely brutally honest with what I was seeing and what I thought the company should do. And if they didn't like it, they could just simply fire me. It was one of many clients. So I could just pick up another client and it didn't matter. So I found that the practice of what I do, the application of my knowledge, I found to be just much more effective. So that was the genesis, if you will, of the fractional CFO model.
Wow, I am so sorry I got, what I say, pushed out by my very lovely internet connection. Many thanks to Talk Talk. Talk Talk, big shout out to you guys. You guys are doing a great job at frustrating the beautiful conversations that I have with wonderful individuals, across the world. Thank you very much for this. I think I would have a bone to pick with you guys. I'm so sorry. So, you were talking about your journey. I don't know if you knew the point at which the internet did cut off.
Yeah. So again, it's those experiences that led me to create sort of that fractional model at the time, which is
Mm.
15 years ago now. So
You did talk
the
about your
fractional model,
MBA. Like after your MBA, like you hit that point of realization. I think another connecting dot as well. I do have an MBA as well, so I'm in the right room with the right person.
yeah, I really enjoyed. I'm glad I didn't do my MBA right after college. I like to think of my CPA experience
Yes.
as my first MBA. It gave me a broad exposure to lots of businesses, but after
Hmm.
being in the game for a while, it was really nice to go back and sort of revisit. What I tell people is that I think my MBA gave me a vocabulary and a framework around the experiences that I had. And I
Hmm.
find that to be very helpful in communicating with business owners and
Yeah,
understanding
very
business models
true.
and just that
And it sharpens
framework.
your business acumen. Actually, it just sharpens it.
It does. It does. And there's a lot of broad exposure there and all of that. So again, it was, I would say the biggest advantage that a fractional CFO like me brings is I have to constantly stay on my game. I have to constantly please my clients. I don't settle in and sort of have a cushy anything. We prove our worth to our clients every month. If they don't feel the value when they cut the check, we move on. And that creates an energy, if you will, to help businesses move forward. I'm a tremendously curious person. So I'm always looking for the next thing, the next piece that we should be doing in the business, the next piece of it. I love technology. We love to apply technology in the businesses. So those are the areas we can really help with. But at the end of the day, it's the accountability and the honesty. Having a fractional model lets me hold our clients accountable to what we talked about the previous month or the previous week and whether they're really doing their part of it to drive their business forward. So it's a partnership. We're identifying the things that are opportunities for them or helping them reduce risk. The job is for them to disseminate that to the organization and move that organization forward in the best way possible. So we sort of act like that accountability piece. We're going to ask them and challenge them and make sure they're doing all they can do to meet their stated goals. If they don't like it, they can fire us. If they don't like the news that we bring, if they don't like it, we have other clients. They're just one of a few clients that we have, and we can pick up another one and move on. So that honesty and accountability, I think, is what separates it. When I was an employee, I was very conscious of delivering bad news
Yeah,
because
exactly.
at any moment someone could get angry and fire me, and my family's at risk and all of that. So this the concentration risk of having many clients, I think, leads to better outcomes. At least when you're dealing with things like finance, which have just as many sort of negative outcomes as positive outcomes.
Mm. It's actually true. But something with business owners, a lot of business owners, especially SMEs, they struggle with financial clarity. So what do you think many of these founders and CEOs rely on their gut instinct, right? Rather than data. So what do you think the fractional CFO can do to guide these business owners in the right direction?
So here's where I'll put on my anti-accountant hat. Once a business owner once described to me their view of accounting as providing reports that they don't understand 15 to 45 days late after the fact. So I think the fact that the accounting sort of profession has created these wonderful income statements and balance sheets and cash flow statements that are perfect for an outsider, an outside investor to understand the business. An outsider understand what the business is doing and how it's performing in comparison to its competitors, how that segment or that company is performing compared to other segments or other company structures. So it's perfect for the outsider. But for the insider, it's old news. At least for our clients, they were there when it happened. So I can come to them and say, here's the income statement and sales are down. My clients will say, yeah, I remember when that client left us. I remember when that customer stopped buying from us. And I can say, hey, look, your gross profits are down a little bit. And they can say, sure, I remember when the supplier raised their prices. I was there when that happened. So I think that they try to make sense of what happens inside of income statements and balance sheets, but it doesn't make sense to how they run their business. And it doesn't tell them what's going to happen tomorrow. It doesn't inform them what might happen tomorrow or help them make better decisions today to move forward. It's purely in the rearview mirror. It's purely behind them. They're wonderful. They're necessary, but they're not necessarily helpful to the business owner. So as a result, they start to develop their gut instinct. They start to develop their informal ways of making decisions. Many of our clients judge inventory not by reviewing balance sheet metrics, but by walking the warehouse floor. Many of our clients understand their sales pipeline not by looking at some data report, but by going out to the sales calls with the salespeople. There's many informal ways they have of gauging how the business is doing, including looking at the bank balance. A balance sheet is not going to tell you if you have money in the bank tomorrow or today to pay bills or make payroll. Those are all the things that they sweat day to day, hour to hour. The balance sheet is a point in time in history. So
Uh-huh.
we work with them to create better reporting so that they can sort of confirm their gut. We start with the income statement, of course, but the first thing we do is try and understand what's going to happen, say for the next 13 weeks of cash flow. That's sort of step number one. Let's see what's going to happen with your cash flow on a weekly basis for the next 13 weeks. That's 90 days, if you will, a quarter. Anything beyond 13 weeks gets to be a little bit hard to predict, and weekly seems to be the right cadence between noise and signal and variability. So that's step number one. That 13-week cash flow forecast, if you will, that's not part of the accounting package. That's not part of what gets presented at a board meeting. So that's the first disconnect we take from traditional financials into something that's much more about management accounting or finance or something that will let them get their teeth around.
That's pretty much PFI, projected financial information.
Sure, sure.
And yeah, that helps with the planning for the future.
Yeah, I
You
would say
know,
our biggest hurdle there is the business owners don't want to make predictions. The business owners often feel like they have to be right. So that's sort of the first hurdle to asking them to forecast something. Many of them have gotten into the cadence of tell me what my sales were and I'll determine whether that's a good result or not. If we make them forecast next month or next quarter or next year, sometimes they'll sort of have a subconscious feeling of what if I'm wrong. And we like to remind them that there's no right or wrong answer.
uh-huh.
A number, a result, a number without a forecast is a lonely number. If someone tells me that their sales went up by 10%, I really don't know if that's a good result. If I add, well, we thought our sales would go up by 5% and we went up by 10%, now I have some understanding. It's no longer a lonely number. I can congratulate everybody and high five everybody because we thought it would go up by 5% and we did 10%. Conversely, if sales go up by 20%, but the goal was 30%, well, maybe we have some more work to do. Maybe we can hold the champagne until we get to that 30%. So it's those lonely numbers that exist on the traditional income statements and balance sheets that we think are missing from what is truly an opportunity to understand why we missed it or why we made it. What were the factors? How did we come up with our target? Is that the best way to create the target next time for next month, next week, next quarter? So we work with this cadence of prediction, and over time you just get better at predicting. You start to understand the blind spots. You start to understand the things you didn't know, and then you go investigate those things, and that becomes part of your reporting. So many of our clients have a daily report of sales, a daily report of sales activity, a weekly report of expenses. They start to meld all of those in, and they start to get a better sense of what might happen. And then we compare it to what did happen. And they just get better and better and better at driving towards those results and understanding what they can do today to make tomorrow's efforts better, not what they can do in the next quarter or the next year. We just think today's business moves far too quickly to have that kind of a decision-making cadence.
I very much appreciate your analysis of the traditional financial statements. The financial statements actually have, anyways, talking about the IFRS framework. I know you guys use the US GAAP, but in line with the IFRS frameworks, there are 5 elements and 5 components of the financial statements. And I used to be a teacher of financial accounting, financial reporting, and corporate reporting. And I always like to break this down to every of my students, especially, financial accounting, which is the basic. The elements are assets, equity, liabilities, income, and expenses. And of course, for the components, you have the statement of financial position, also known as the balance sheet, right? And the income statement, right, which is a profit or loss statement. But those two are the traditionally most important statements. Of course, you have the cash flow statements, you have the statement of changes in equity, and of course, you have the notes to the financial statements. But those first two, the balance sheet and the income statement, have become so popular that even very small organizations, SMEs, right, just produce those two and, make financial decisions, opinions, right, based on those two statements. However, they are highly, highly limited in terms of the level of data that they provide you. Like you rightly said, the financial position, right? And that's why I really like to call it the statement financial position, right? Instead of calling it the balance sheet. It just shows you the financial position at a point in time, right? At a point in time. The income statement, yeah, is still even more robust in the fact that it actually shows you your, would I say, the bottom line, right, over a period of time, which is typically 12 months, right? Now, there are ratios that are very, very important in order to assess the financial health of an organization. And I was telling a business owner recently, there is a difference between your liquidity and your solvency. Your liquidity is your ability to settle financial commitments in the short run. And of course, your solvency is that ability to settle them in the long run. However, a lot of people confuse solvency for liquidity. Of course, your balance sheet, like you said, just shows you your solvency. But how about your liquidity? Your liquidity is what keeps you in business, right? And of course, that is what helps you to stay as a going concern. Now, you have been on the field, doing that dirty work as a fractional CFO, right? And we both understand the struggles that SMEs go through. And you often talk about bridging the gap between financial numbers and business strategy. So, how do you make finance more accessible for these entrepreneurs? And how do you help them understand the implications of the numbers?
So the first step is a little bit around what you were talking about, those ratios. We often find, here in the States at least, that there's not a lot of financial ratios that get published along with our balance sheet, which truly is, a statement of financial condition. I love that word, far better than a balance sheet. So what we like to think of as ratios is often the magic tie between the income statement activity and the point in time on the balance sheet. And it really helps you understand and tie those two together. That's the beauty of ratios, we think. Also, ratios, by their definition, work really well in comparison over time. So we're big fans
Uh-huh.
of monthly trends, quarterly trends. Yearly trends, not so much. In the SME space, things move far too fast, far too quickly. So the ability to compare ratios month over month, year over year, quarter over quarter, working through seasonality, the ratios have a tendency to create more signal than noise.
Uh-huh.
And
Yeah,
and that
very, very
that
right.
yeah,
And
that comparison.
sorry to interrupt you there, right? I just
Please.
want to corroborate something that you're saying. I see the ratios are as metrics that measure the financial health of organizations. Just like, you have your pulse rates, your is it blood pressure,
Blood
your
pressure.
heart rates are like, just like the signals, even like your BMI, body mass index, your muscle to fat ratio, that is what ratios are, right? For the layman who does not understand, that is what ratios are to our business. They're just metrics that measure the financial health. And of course, we as human beings, we have physical health, but businesses, right, are individuals as well. They're entities, right? And of course, you need to always check their health. And that's why we have financial doctors like this.
No, thank you for that clarification. It's a great analogy. It's a wonderful analogy. Blood pressure is, a ratio as well, right? You're measuring
Uh-huh.
systolic pressure, something over something. We deal with ratios in our everyday life all the time. We just may not realize it. So we're just applying those concepts, like you said, to the financials. There's one other benefit to ratios that I think is often overlooked to medium enterprise space, often because the business owner and the management team doesn't use the financials. They use their gut. They use their informal ways of making decisions. Oftentimes, the accounting can be wrong, and I use the word wrong with lowercase letters. Sometimes they can not be accounting for transactions in the best way. There's sort of best practices around how to account for revenue, how to account for expenses, introducing accrual versus the cash basis, reserves, all that sort of technical accounting things that I don't want
That
to
is why
bore
we
you
have
about.
financial reporting standards, and of course,
Correct.
it's not wrong in small case. It's actually wrong in big, bold italics.
Right. 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 And so what ratios let us do is, even if the accounting has some sort of technical things that we need to fix, usually those things are not changing. Usually the procedures that are not being done, or the errors that are in the financials from a procedural standpoint. I'm not saying the numbers are not right. They're just not being handled correctly inside of the accounting framework. As long as that's reasonably consistent going backwards over 36 months or 48 months, we can use those ratios to understand a trend, even though the accounting might not be right, even though they may not be recording inventory on each month on their as a manufacturer. They're just taking all of their purchases and driving it towards cost of sales. A big no-no, if you will, right? You need to have ending
Mhm.
inventory, beginning inventory. You need to match revenues and expenses. But even if they don't, over time, while the numbers may be wildly variable depending on the activity, those ratios tend to coalesce towards a certain number. So even if we have historical financials that are not prepared inside the framework that we like, we can still use those numbers with a ratio to help guide what might happen in the future. That, I think, is sort of an unknown piece of ratios that can really help when we're bringing on a new client. When our clients finally say, we want to do better, we want to make better decisions with data, we start with getting the financials right, but we can still use historical information using ratios in a way that we can't use the actual numbers. So I just want to, we consider that to be another true benefit of ratios. It really does take away the noise and highlight the signal.
So, trying to do a deep dive. So,
Yep.
what are the financial blind spots business owners oftentimes overlook?
I would say the first one is ensuring that revenues match to expenses, so that the activity that we're looking at properly reflects what happened. Beyond that, we find that there's not a lot of detailed reporting inside of accounting, especially for companies that have been in business for a while, because historically we have a trade-off between granularity in the financial statements and cost. If I have an invoice with 150 lines on it, as a finance person, I want that all 150 lines on that invoice to be entered in individual line items in the accounting system. But the accounting department might just want to make one entry for that. So I lose granularity when I make just one overall total entry, but the invoice gets input immediately and they can move on to create another invoice. Now we're in an age of everything is digital. So the cost of putting in one line or a million lines is the same if it's all digital. So that's where we push really hard on the technology side. So the next thing we do is try and get as much granularity into the financials as possible so that we can look deeper at the data, understand customer activity, understand item activity, understand vendor activity. Make sure those are sitting in the financials, not in a spreadsheet somewhere else, not in another source of data, not in another source of truth that may or may not have all the reconciliations, may not have the complete data. The advantage we have in the financials, it is the complete data picture. We are reconciling it to the bank account. We're reconciling it to outside vendor statements. We're reconciling it to outside customers. Customers always will tell us if the invoicing is correct, because if they pay it, it's correct. If they don't pay it, it may be because it's not correct. So we have outside we have ways to verify that the numbers we have in the financials are good.
In order to say the most reliable form of audit evidence is third-party
Yeah.
evidence. But
Yeah.
then I want to quickly highlight something that you said, and it is very, very important. The matching concept. It is a whole very important concept in accounting. I'm a financial accounting teacher, and it is one of the very, very first things that I teach students that are new to the concept of accounting. Just after your double entry principle, you need to understand the concepts and the conventions of accounting, right? And of course, one of the very important concepts, your prudence concept, your matching concept in an accounting period, right? The revenue, the income that is earned, keyword earned, not necessarily collected in that period, is to be matched with the expenses that were incurred in that period. And of course, keyword is incurred. So by way of my experience in public practice, right, I've seen multiple situations wherein a client, an entity is collecting, money for a contract, right? And of course, that's why I really, really love IFRS 15, revenue, breaking it down as to how you actually recognize revenue. It even has a 5-step model, right? From, identify the contract to the customer down to breaking down the what's it called? What do you call it? I have forgotten, but basically breaking down what you need to do per the contract, and of course allocating the transaction price. Right now, a lot of what do you call them, clients actually, because you've collected money, for example, you got money for a 5-year service, and of course you're recognizing the whole of the revenue in that year. Like,
It's a big problem. It's that first step towards using a true framework for accounting. And I think there's two things that we highlight when we're introducing the concept of matching. It's a beautiful way to put it. I appreciate you putting it that way. The concept of matching has two elements to it. For right now, what is the proper recognition of revenue right now? So if someone pays us for 5 years, next month our sales are probably going to go down if we record all that
exactly,
revenue.
and of course, it gives illusionary
Uh-huh.
what's it called, picture of what your
Yep.
revenue is, and that
Yep.
is not right.
And we may spend a lot of time investigating why did our sales go down so much. We might run around thinking the sky is falling. We might run around thinking the sales department has let us down. The world's going to end because my sales went down dramatically. But then we realized it was because someone paid us for 5 years, and all that work that we did to uncover that is wasted work.
Right.
So that
It's so crazy. Like it just makes the financial statements, lopsided. But then,
yep, yep,
IFRS 15 is very, very clear. 5 steps, right? Number one, you identify the contract with the customer. Number two, you identify all the individual performance obligations within that contract. Number three, you determine the transaction price. Number four, you allocate the price to the performance obligations. And of course, number five, you recognize revenue as the performance obligations are being fulfilled or satisfied. Very simple.
correct. And so the other piece of that, the part that's not talked about, is the obligation you have for the next 4 years and 11 months to perform that service. And
Exactly.
that's the piece that I think business owners have a hard time contemplating. It's relatively easy to say, okay, I get that it's not all my revenue, but if you don't perform in years 2, 3, and 4, you probably have to give some money back. You probably have to do some sort of a credit. You probably have to adjust the contract. There's additional costs that come into play. So it's both the recognition of revenue, but more importantly, the obligation on your balance sheet for future periods that you have to make sure that you have the resources, the cash, the working capital, the operations to perform that for the future.
Yeah, exactly. And that is why the step 5 actually is very clearly stating that you should recognize revenue as the performance obligations are being satisfied, right? And of course, revenue is different from deferred revenue, right? Your revenue is an income, right? But of course, your deferred revenue is sort of a liability because you have not performed these obligations. And like you rightly said, you may have to give back money to your customer. But a lot of
Yep.
SMEs do not realize these very, very simple concepts that you are the what I say, the doctor that has to pass this to them.
Well, I think historically it's been difficult to do that. So in our with our client base, with our companies, it's things like marketing companies that will, invoice for a website build that might take 2.5 months. And they'll invoice in 1 month, they'll start the project in the following month. That requires for every transaction a determination of when the project will start, how
Uh-huh.
long it will take, and which months we want to recognize that revenue. So sometimes those are front loaded costs. Sometimes a website has a tremendous amount of work going in the first month and then a little bit in the second month and hardly any in the third month. So there's adjustments that need to be made. There's estimates that need to be made. And those typically, the accounting department doesn't have time to do that. The other departments don't have time to make those estimates. So that's where we find that technology, those trends, just creating some baseline rules
Uh-huh.
can make that automated. So we have
Yeah.
technology that lets that one transaction get spread over those 4 months,
Uh-huh.
roughly consistent with how it used to be in the past. People get
Because a
really
lot of them do just put it on a straight line basis, and
right,
that doesn't show
right,
a correct picture.
right, right. And so they also think they have to be completely right, and they don't. They just have to be directionally correct. And so those are how it plays out. The other place we see it play out is SaaS companies or technology companies or software companies where they might sell a monthly plan or a yearly plan. The monthly plans, we can recognize that revenue.
Uh-huh.
The yearly plans, we really need to back out the future 11 months, or we can get more granular and split it by the day or by the beginning of the month or the end of the month or middle of the month. There's all kinds of different ways we can get there. The platforms make it very, very easy to do that. Historically, it's all had to be done in Excel
Uh-huh.
spreadsheets,
Uh-huh.
manual work, lots of back and forth. And so that's, I think, why, and again, those things historically have been very expensive. So I think that's why it hasn't been done more often at the smaller levels, smaller entity levels. But now with technology, a company with $1 million in turnover or sales can operate just like a company with $1 billion or $1 trillion in sales. The
Mm.
accounting,
Many thanks to AI.
yeah, yeah, thanks to AI, thanks to technology, thanks to all kinds of things. So those are the concepts we bring into play. We're not looking to make accounting more expensive. We're actually looking to make accounting less expensive. We don't want people banging on the keyboards. We want people managing the data. Entering data is last year's news. Managing the data is tomorrow's news. We want to get you there. So when I walk into our new clients, I often see the accounting department, they look overwhelmed. They look very busy. They have stacks everywhere. And that's not, in my mind, the best way an accounting department should operate. I'd like to see them sitting back with their feet on their desk, nothing, no papers anywhere, just waiting for some problem to happen. And when that problem happens, they have all the energy and attention to bring to it, and they can take care of that right away. But if everything's working well in accounting, there's not much work to do. And business owners don't understand that. If they would normally walk into an accounting department and think they're all goofing off if they're just sitting there with their feet up. No, they're there to make sure everything's working well. And there's no problem if everything works well. That's a good result. But you need to have that energy. You have to have that bandwidth. You have to have that curiosity for dealing with the problem when it occurs. And if you spend all your energy doing data entry, moving invoices from one side of the computer to the other, you spend all of your time just getting to the point where the pile is lower, you have no energy to deal with the real issues. And that comes into play in accounts receivable departments all the time. They're so busy getting the data in that no one's managing the clients that are 2 days late, 5 days late.
Receivables and payables.
Yes. Yes. And that's the real function of those departments, is to manage those things, but they're so busy entering those things.
With the advent of tech, we should actually be faster, better, and stronger.
Yeah.
Right. And what a great way to segue to my next question to you. And that is, what common financial mistakes do businesses make that cost them the most money, and how can they avoid them?
We have a theory that we abhor averages. And by its very nature, financial statements are averages. So when we look at a company's gross profit, it's an average of all of their transactions for the month, the quarter, or the year. And we think that there's large variations inside of that gross profit or gross margin. We think that there are customers that have certain items or services that are highly profitable, that might make up 80%, 60% of the profits. We think that there are customers and item combinations that are sort of break even. They might make 5%, they might lose 5%. And then we think that there are certain customers and items combined that you lose a lot of money on, that are big drains on profits. But if you average them all out, they might come to a 25% gross margin. So you might have a 200% or a 400% gross margin for certain combinations of items, customers, and vendors. And you might have a few items, customers, and vendors that you lose 50% or 25% on, but the vast majority are in this minus 10 to plus 10, which averages out to maybe 25%. So that's where we feel step number one is, again, we like the granularity. We can't do this if there's not customer data, if there's not item data, service data, efficiency data, labor data, all of those things. But we find that the law of averages works against you when you're trying to make decisions. An example would be a customer that has been with you for a very long time. They've probably over time asked you to do a lot of different things. And when you're a new or a young or a small organization, you say yes to everything. That's what you do. You say yes to everything.
Absolutely.
But at some point, you get enough other customers, you get enough profitable items, you get enough profitable processes or services that you sort of develop a really good product. But you're still doing a lot of other things for some of these customers. And those things are probably costing you a lot of money, or they're probably far less profitable. So we don't come along, and when we identify those things, we don't say, stop doing them. We say, let's go have a conversation with the customer. A lot of this is about visibility in the ecosystem, in the supply chain, in the value chain, and say to the customer, some things we're doing for you are working out really well for us, but some of the things are not working out well for us. And so we'd like to talk about maybe raising the price of it, maybe having you go somewhere else for those things. Now, these are difficult conversations to have.
Very difficult.
But you might find
Been there, done that.
you might find the customer says, you know what, we were just giving that to you out of courtesy. We would love to buy those things from someone else. We we have loyalty to you. So
Mhm.
conversations around loyalty, conversations around why the customer is buying from you, there's never a bad result from that. It's sometimes you don't
Mhm.
want to know the answer, but there's never a bad result in communicating with your customer and just
Mhm.
talking to them about how things are working for you and how things are working for them. And maybe it's time to talk about doing things a little bit differently. It's not about stopping. It's not about changing in a dramatic way. It's about
Mhm.
implementing subtle changes over time so that the true things that drain your profits go away. The things that make you a little bit of money or lose a little bit of money, you make money consistently with those things. And then the things that are highly profitable, you would align the entire organization around doing more of that for as many people as possible. So I think the law of averages works against business owners in that hiding in their profits usually is a lot of variability, a lot of variance. So we just exploit that variance and try and understand how to improve that. It may not happen in 30 days or 60 days, but over a 90-day, 180-day, or a 365-day period, you can probably make a lot of progress on that. Doesn't require any additional investment, doesn't require more salespeople, doesn't require more accounting help, doesn't require more warehouse, doesn't require more rent, doesn't require more stuff. It's just those conversations and then aligning things around how to do that better.
Thank you very much for that insight. And of course, for companies that struggle with cash flow, I did talk about the liquidity situation, right? A lot of our SMEs confuse solvency for liquidity, but they are not the same thing. And of course, if you do not pay attention to your liquidity, you would very likely be having cash flow constraints. So for companies that are now knee deep in cash flow constraint situations, what are the first three things they should do to regain their financial control?
Yeah, ideally, don't ever be there, right? That would be ideal.
Ideally,
So
in an
so
ideal world.
right, right. So you find yourself in a position where your liquidity is squeezed, where your working capital is either not available or smaller than you need. That's
Mhm.
usually a combination, a result of increased sales on account, sales on credit strain the organization. So the first thing we do is map out, like I said before, that 13-week cash flow. Let's just see where you are. What's today's bank balance? What are the things that are going to come out of the account in the next week? And what are the things that are going to come into the account in the next week, into the bank account? And let's do that for 13 weeks going out. And then let's start to compare what we anticipated with what we saw. So that's step number one. Is there a pathway out? Do I need to borrow money in the next, 6 weeks from now? Is there a way that my cash crunch now can be manipulated, massaged, discussed so that when I have more cash coming in 9 weeks or 3 weeks, I can defer some expenses. I can go to my suppliers and ask for a deferred payment plan. I can use my relationships to make it work between here and when things get better. So that 13-week cash flow is number one. Number two, it's having those conversations about deferring things. And everyone in business has struggles. So oftentimes people don't want to go to their customers and ask for early payment. They don't want to go to their suppliers and ask for delayed payment. These are items of pride. These are items of perceived reputation. But the reality is everyone has been in these situations. And most of your supply chain wants to help you out. They're more of your partners than adversaries. So that's step number two. Along with that, make darn sure that you keep those people in communication. So if you've promised to pay somebody a week late, let them know if it's going to be a week and a day late, or let them know if it's going to be a week and 2 days late. Don't wait until it's 2 days after you said and they're calling. So that communication is critical. And then number three, start to adjust things going forward. Start to use those cash flow planning to make sure you're not straining the organization, which got you there in the first place, to make sure that you're deferring some sales, which again, to most business owners and certainly sales teams sounds antithetical. Like why would we ever delay sales? You get that sale whenever you can. No, because you may not be able to deliver on that sale. So have that honest conversation inside the organization about how much working capital do we have? So how much growth can we afford? So these things all come about. We hear them in terms like I have tremendous sales but no cash. That's a working capital issue. That's uh, that's that's the the result of rapid growth. Because if I have 30-day terms on my sales and I double my sales, then I'm usually paying my payroll every week or 2 weeks. I'm paying my suppliers throughout the month. I'm paying for things early, but I'm in essence funding my sales for my customers. I've become a bank when I have terms on credit. And so collecting on that bank loan becomes crucial. Sometimes that growth comes from clients that are less creditworthy. So now I have increased
Exactly.
risk from those. Sometimes those sales come at lower margins,
Mm-hmm.
depending on who controls pricing in the organization. So sales going up isn't always the best thing. Sales going up with profits going up and cash going up, that's the ideal piece. So we just try and frame the growth in what the company can manage so that it doesn't outstrip its abilities. There's one interesting corollary here that I'll talk about. Oftentimes in a cycle of growth, a cycle of steady, or a cycle of decline in a business, if they have receivables, if they sell on credit, when you're growing, you have extreme constraints on cash.
Mm-hmm.
But when you're declining, your cash balance goes up dramatically because you're no longer selling, you're no longer purchasing items, you may be cutting staff. The hard part of managing just your cash balance is when sales are declining, your cash balance actually goes up. So you think you're in a good position, but you're not. So, that again, we just want to frame things in what do we think will happen, what did happen, and what can we do about it?
Are interesting. I really appreciate that deep dive. I'm gonna add something to that. You did mention a lot about working capital, but the accounting teacher in me, wants to break it down, for further understanding. Your working capital is actually a ratio, and that is your current assets minus your inventory, divided by your current liabilities, breaking it down in more granular fashion. So you see that that working capital is very, very important. It's I would call it pretty much the most important measure of liquidity. Back to what I was saying, liquidity. And of course, solvency is more long-term in nature. But then if you do not take care of your liquidity, you might end up having going concern issues. So part of solvency, is how you manage your debts and how you manage how leveraged you are as an entity. So I am curious to know what your take on debt in business is, and when is it a smart tool for growth, and when does it become a dangerous trap?
It's a great discussion point. So we like to think in terms of leverage and we like to think in terms of risk. So oftentimes we'll talk to our clients or a new client, or I'll talk to a business owner and they'll say, my business is run very, very well. We have zero debt, as though that all by itself is a measure of how well the business is running. Now, if you have zero debt, you probably don't have a lot of risk in the business. You probably have a lot of cash. So the risk of going out of business, the risk of insolvency, the risk of liquidity, you're probably doing okay. My first question to them is, wow, you don't have enough confidence in your business to leverage it and invest in it to do more. And that's sort of the beginning of the conversation. So if you're borrowing money to cover past mistakes, that's a problem. If you're if you've identified areas where you are secure, you feel there's little risk in expanding an area that's profitable. Again, customers and items, customers, items and vendors, the combination of those things. If you feel comfortable that if you sold more, you would make more, that's operating leverage at its finest, then leverage that. If your sales generate a 20% return, 20% gross margin, and you can borrow money at, let's use round numbers, 12% interest. Again, a couple of years ago, that would be preposterous. These days, that's probably not an inaccurate number for many people. But many people confuse, now I'll get into the velocity concept. So if I make 20% on every sale and I can borrow money at say 12%, well, it's 12% over what time? It's actually 1% per month. So I'm borrowing money at 1% per month. And I'm making a sale where I'm getting 20%. And let's say that I have 30-day terms. So the sale I make on the 1st, I collect on the 31st. Beginning of the month, end of the month. First of the month, first of the following month. Well, now I've got that money back into the organization, and I'm now able to sell something else at a 20% margin. But I've only paid 1% for that money. Now, the second month, I've made 20% and 20% because I've sold things twice, and I've paid 1% plus 1% on debt, or 2%. And then the third month, I sell 20%. Now I'm at 20% plus 20% plus 20%, but now I'm only paying 3%. That's the leverage, the operating leverage that I'm talking about. The velocity. I borrow the money once, but I turn it 12 times, 24 times, 48 times, 64 times, 128 times in the year. So I borrow it in the first of the year. I turn it so many times throughout the year, and then I repay it at the end of the year. That makes sense. But if I'm borrowing the money to cover a past liquidity issue, a past problem, then I don't have that advantage. There's nothing I can sell tomorrow necessarily that will ensure I can pay it back. So we talk about risk, we talk about velocity, and we talk about returns. And that lets me know how much the company can efficiently or effectively borrow and whether they should or not.
I appreciate that, simplistic um, explanation of the concept of leverage, the concept of velocity, and of course, the concept of return on investment. That was well put together. And that's well appreciated. Talking about moving from instinct-driven decision making to data-driven decision making. You emphasize the shift from intuition based decisions to data driven strategies. What's the first step a CEO should take to make this transition?
There's so many things that they need to do. So step number one in my mind is set a target, set an expectation, set something to drive towards. We talked about that earlier. So if you know if you put a marker in the sand for where you think you're going to be, then if you make it, there's only three things that can happen. You'll make it, you'll overshoot it, or you'll undershoot it. And all three of those results result in data. They result in things that happened. They result in tests against your hypotheses, tests against your assumptions. And you go back, and then the next line you put in the sand, you're probably a little bit better at understanding the 9 things that impact it rather than the 3 things that impacted that you thought when you first did it. And then you have another result, and you either overshoot it, hit it, or undershoot it. And then you start understanding why you had those results, and you realize it's not 9 things that impact it. Maybe really it's only 6, or maybe it's 12. But if you do that a few months in a row, a quarter or two, all of a sudden you do uncover all the drivers of profitability, all the things that affect your profitability. So just the first step is setting that target. It's the hardest thing to do. It requires you to make a statement. And you have to realize that the goal is not to make the statement right. The goal is to learn something from the statement. So that, to me, that's step one. Step two, get better granular data. Get better things where you can make decisions. Bring in non-financial data. Bring in things that are about to happen, not just did happen. Bring in your sales funnel. How many phone calls are being made? How many visits are being done? How many new doors are your salespeople reaching versus existing doors? How much of your growth is coming from existing customers? How much is coming from new customers? Again, this law of averages, if we don't segment our sales in as much granularity as possible, all the churn, all the growth, all the contraction, all the changes, all the problems get hidden in this thing called sales. So the more we can understand what's happening at every customer, at every transaction, and every item level, the more we can generate trends. Why did these customers stop buying these products? Why do these customers buy these products and these products over here? Why am I delivering such a far distance away? What is my minimum order size that I should have for clients that are close nearby, far away? How frequently should I be doing things? You know, are there opportunities to both increase profitability, or are there opportunities to reduce? So those are some of the things that come from this more granularity. So those are the first things to uncover the gut and get more towards the data. You mentioned before, or a lot of people talk about crunching the numbers. And I like to think of this process for the business owner as really uncrunching the numbers. So we take all the activity that happens every hour, every day, every week, every month, every quarter, every year, and we crunch them into financial statements. What we want to do is we want to uncrunch that. We want to open those up in a very systematic way, not in a way that creates entropy, not in a way that creates confusion, but a systematic way. We're going to uncrunch those things and try and find those trends that make up those summary numbers, those averages, those trends. So to me, uncrunching the numbers is the most important thing you can do to make better decisions with data.
So speaking of uncrunching the numbers, right? So what are the key financial metrics or KPIs? By the way, KPIs are key performance indicators for the layman watching us. I don't like to use a lot of jargons that are not relatable to non-accounting professionals. So what are the key metrics, the key performance indicators that every business owner should track to ensure long-term and sustained profitability?
How much time do we have? Do we have a couple days? Because I could go on and on and on and on and
we have
on.
all day.
So,
And of
right,
course, that's why I said the key ones, the
right, right,
keyword, key
right.
indicators. I know I'm a numbers
So
guy like you too, so I
big,
don't want you to go all day. I just want to give us the key ones.
yeah, big passion of mine, right? What
Mhm,
gets measured gets done. That's the end of the day. That's
mhm.
how we live our lives. That's how we approach our engagements. So we've identified 10 key ratios that every business owner should know and understand that fit across all business models. Happy to send that out to your listeners and all of that. I won't
Yes,
bore.
that'll be well appreciated. I'm going to put that in the description.
Sure,
So, in case you're
sure.
watching, watch out for the 10 key ratios or 10 key indicators
Every
that
business
every
owner.
business owner should
Yep,
look for. And of course, thank you
yep.
very much, Ken. We appreciate this.
But let me give you an example of what a key indicator might be. It's known as key metrics, key drivers, key indicators, OKRs, key leading indicators, key past indicators. There's lots of different things you will hear, but I do like the KPI concept, the performance indicator concept as a general one.
Okay, you
Step
can just
number
list
one.
them. So, they will be in the show notes. And of course, I'll add them to the description. Thank you.
Yep. So the concept around KPIs is, I think, illustrated well by this. The first thing that we do when we go into a client is we do a financial metric and compare it to a non-financial metric. And the one that we start with is employees as the non-financial metric and sales as the financial metric. So when we first go into a client, we'll ask them for the last month, 3 months, 12 months, 36 months, give us the number of people you had on payroll, the number of full-time equivalents if you can. In other words, the number of full-time positions. If two people work part-time half a week, 2 half weeks equals one full-time employee to oversimplify things. But give me your employees or FTEs just at the end of every month. Then tell me what your sales are for every month. If I take sales and divide it by employees, I get sales by employee. Now I immediately know how efficient the organization is from a labor standpoint. Because if sales go up, I don't know if that's because I raised my prices, or if I had more customers, or if I sold bigger units. Now, if sales go up because I've raised prices, then my efficiency hasn't gained. I've just I'm able to do, in other words, raising prices is a one-time hit. If I sell to more customers, chances are I need to create more salespeople or more people somewhere in the organization. So the question becomes, for the additional sales that I'm getting, am I leveraging my employees? If I'm adding my employees faster than I'm adding sales, then I'm not leveraging things. And conversely, if I'm selling more things, I need to hire more people theoretically to produce those things, to produce the services. So I can look at sales by employee trends and know instantly how effective the organization is leveraging labor. It jumps out at you. It's a number. It's 100,000 per employee. And then it goes to 110,000 per employee. And then it goes to 120,000 per employee. Now I know I'm being very effective. If it goes the other way, 273,500 per employee, 269,273 per employee, 253,950 per employee. Now I know something else is impacting me. I'm adding sales, but they're not I'm not leveraging my labor. The second thing, then you just apply it to gross profit and you apply it to net income. So the sales by employee will tell you how overall your business is doing in terms of efficiency. That trend, it's not a single number, it's a trend over time. The second one is gross profit. So how is my gross profit being impacted by the number of my employees? That tells you right away if the sales are being made at list price, above list price, or discounted. It's a great way to understand where the growth is coming from. And again, these are beginning numbers. These aren't the answer numbers. These are the question numbers. But from here, you can start to ask the right questions. And then finally, net income. So for all of my activity that I'm doing at the top line, and for all the delivery that I'm doing of the services and the goods, how is my fixed costs, my rent, my admin function, my selling expense, my utilities, all of those things, how am I leveraging those fixed costs over what's happening with my sales and gross profit? That's net income by employee. Anyone can understand that number. That's a number that's easily talked about. And again, it's not an answer metric, it's a question metric. So we like to start there. And believe me, there's no shortage of things we can measure inside your organization. The question is finding, like you mentioned before, the real drivers that we should be measuring.
Exactly. Some businesses do track vanity metrics, and it's a total waste of time, because these vanity metrics don't actually contribute to growth. So what are the common ones, and how can companies focus on the numbers that really matter?
Well, again, I think it's business model dependent. It's data dependent. What kind of data do you have? So I hesitate to create an overall one. Again, we've got the 10 that we'll talk about. I won't bore the audience with all of those, but they're gross profit ratios, net income ratios, debt to equity, current ratios, interest coverage ratios, your ability to borrow, your ability to pay back, your liquidity, like you mentioned before, trends on things. But really, I hesitate to give anything broader because I could give you all kinds of performance indicators. The question is, for my business right now, what is my key? What do I need to measure? So the performance metrics can number in the hundreds of the thousands. The key should be less than 15, ideally
Mhm.
5. And if you can get it to 3, that's phenomenal. You won't be able to do that month 1, but maybe month 6, we can start to truly see where what we truly should be measuring. What's the essence? What's the most concentrated measure? What's the most impactful measure? What's my profit driver? What's my true profit driver? My true cost driver? Those are the things that get distilled, we'll call it. We put all kinds of ingredients into the hopper, and we put a lot of energy and a lot of time into it, and we distill out this very powerful, very concentrated set of data that truly tells us what we need to know. So that distillation process can take 30, 60, 90, 120, 180, 365 days over time. It's something you should constantly be doing. It's a constant thing. It's a lot of heavy lifting in the beginning, and then it's a lot of light lifting or discipline over time. Just like losing weight, just like getting in shape. The first steps are the hardest, but once you're in that routine, it gets incrementally easier to make progress. Momentum, just the discipline of always looking at key indicators and not resting on them, but moving forward with, are they still the right ones? Does it still make sense? Those are the things we encourage our clients to do and we help them with. We're their data partners in this process. That's what we do. That's the bandwidth we bring. That's the focus we bring. The other advantage to a fractional CFO, to kind of wrap it to a different concept that we talked about earlier, when I come into an organization or when my team comes into an organization, we don't know what the financials are supposed to say. We look at it from that 30,000-foot level. We aren't influenced by all the activity that happened all month. So we come in with a fresh set of eyes and we just say, here's what we think we see. And we find that to be exceptionally valuable because we all know that if you proofread your own memo, you're likely going to miss some things because the brain naturally knows what it's supposed to say and it'll overlook any of the individual problems. Like the number of times I've put the and the next
The
to one
danger of
another.
self-review
Danger.
threat.
Yes. Yep. Yep. So the same thing happens with financials. And so we don't know what it's supposed to say. So we just come in and start asking questions. And sometimes those questions can unearth insights that are not evident to those that were there every day.
Mm, that's actually very true. But interestingly, as you were speaking about the nature of the organizations, right? Different organizations have different peculiarities, like they say, different strokes for different folks. And also, different organizations have different stakeholders, right? So for some, and the different stakeholders have like different interests. So it depends on the type, the structure, especially the equity structure of the organization. So, for example, a limited liability company would have, major stakeholders as the shareholders, and they are likely to be interested in the bottom line, right? That is the profitability. We could have, a public limited liability company, and of course, they have more owners, right? And of course, those stakeholders probably are more interested in, things like the price earning ratio, the long-term profitability, the long-term indices, basically. And if you have a not-for-profit organization, they are probably looking at, total assets, right? So different organizations have like different stakeholders. So how do you deal with the interests of the stakeholders and still ensure that the data, right, that you're crunching is very much aligned to both the interests of the stakeholders and the going concern of that organization?
So I think it's helpful to think of all interests as being somewhat aligned, just having less bandwidth for understanding the granularity. So if I'm an investor, I would love to know all the details about the sales, but I don't have any time to do that. I'm doing that for multiple companies. I don't have the ability to perhaps understand it. So the granularity that exists for the management team doesn't help me as an investor. So that's where you start with data to make better decisions. You start with reporting against the decisions. And all along the way, those roll up into financials, they roll up into ratios, they roll up into cash flow forecasts, they roll up into discounted cash flow, they roll up into valuation, they roll up into EBITDA, they roll up into margins, they roll up into share of market. So all the measures of what the high level investor is looking for, what the mid level board of directors is looking for, what the individual managers are looking for each of their departments, all of those things start with the granularity and the decision making that gets done every minute, every hour, every day, and every month. And if you're that agile and nimble and focused, then the results should naturally improve, or at least the problem should surface. And then you can have conversations around the numbers. So it's great to start with ratios at the top in a financial report for investors. But the true truth of the organization is in the management comments. That's where management is sharing what happened, what is happening, and will happen, say for a public company. It's the interpretation of those numbers and what those forward-looking statements might look like, where the real value is. So if you're an investor, just looking at the financial ratios, you're missing a lot of the story. And all along the way, downwards from again the investor into the manager, into the board of directors, the board of advisors, the management oversight, the employees on the shop floor, they all need different sets of data. Some of them need it in summary, some of them need it in segments, some of them need it in trends. We're big fans of open book, for instance, but we would never share salaries with the entire organization. But we might share labor percentage for every item that went out and see if labor is improving. So there's certain summary metrics that are very valuable to people that want to celebrate or that want to know where the direction is going. So it's kind of a long-winded answer, but the more data you have doesn't mean you can't summarize it at some point down the line, but you can't take summary data at the business level and expect to make better decisions with it if there's not enough granularity to understand. So there's no downside to granularity. Everything rolls up into the things that investors have historically received. The granularity ensures that those results are either better or there's more discussion around what needs to be done to make them better.
Wow, interesting. And, speaking of summarizing, AI has been very, very valuable in that respect. So, what role does AI and automation play in modern financial decision making? And of course, how can businesses leverage these tools effectively?
AI is very dependent upon data. So
Mhm,
again, we come back to Ken's rule of granularity. The more you have, the more AI can help you.
mhm,
So we're encouraging all of our clients to collect as much data as possible into one, in essence, single source of truth somewhere. Historically, that's been called a data warehouse. We think there's a lot of constrictions around the data warehouse concept. There's much more free-form data that you can store now. You might grab data and have no idea what format it's in or whether it'll be useful. But storage is so cheap, just grab it and archive it. Put all your data in all of its messiness in one place because AI has the ability to take that messiness and create order from it.
mhm.
So we think that there's opportunities around AI to understand what the rest of the world thinks. It's a great tool for coalescing how the rest of the world views things. So for things like marketing scripts, for things like research, AI is very, very helpful. Now, you have to make sure that you as the user understand what you're asking it. I think that's prompt engineering. That becomes very important.
And garbage in,
So
garbage out.
right, right. So the more effective you are in framing the question, and I've
Mhm,
seen prompts that are 500 words long, 5,000 words long.
mhm,
AI is not, where can I improve sales? That's that general question is going to give you an extremely general answer across the body of knowledge for the last 100 years. But the more I can frame the question, the more I can do that prompt engineering, the better off I'll be at the responses, and then ask the response with the response, ask AI to think about it again, to take another pass at it. Most of us don't come up with the right answer on the first time. So
mhm.
ask AI to take that answer and evaluate it and research it again. So it's no different than typical decision making. You just have a much broader place to play. AI in accounting has been used for a long time. I think it's more machine learning, but they're two peas in a pod, I think, in my mind. But invoices that you get from customers, they're the same. Bank statements that you get from banks, they're the same. The numbers are different, but the format is the same. Humans have a hard time remembering that. Machines, they excel at it. So machine learning or AI around automated invoice entry, around automated billing, invoicing, all those automations, machines are wonderful at that pattern recognition, pattern matching, and that goes back to reviewing things in accounting, not doing things in accounting.
Mhm.
Someone might say, well, I can't trust that I can put all my invoices into an AI engine and have it be right. No, but chances are 99% of it will be right, or they'll be right until you get a new vendor, or they'll be right until you get a two-page invoice or some edge case. So work on those edge cases for all new suppliers. We review them manually, right? There's just you can break
Mhm.
it down into those chunks. So we as humans we tend to take the worst case or the hardest case and apply it to the entire process. And that's truly not right. 80, 90, 60, 70, some percentage of things behave the same. And so focus on the edge cases, focus on the things that are likely to be different or likely to change or be inaccurate, and put processes and procedures around that. If AI is doing its job, you should have plenty of time to handle those edge cases.
Exactly, exactly. Well put together. Earlier in our discussion, you were talking about how you are an expert at scaling up, our companies, and there are methods, would I say methods to the madness, right? Scaling smart, and of course, financial strategies for growth. Now, what financial strategies should a company adopt when trying to scale up from being a small company to being a mid-sized company? You said it yourself. It's well documented. It's your bread and tea. That is your bread and butter. Scaling up from small to mid-size. But then when it's beyond mid-size, you tend to back out. So, what are the strategies?
So I think the goal is to grow within the capacity of the business. That's number one. That goes back to your liquidity and solvency question. So that's step
Mhm.
number one. But let's assume we've got that taken care of. So now it becomes adding processes, infrastructure, repeatability, moving from tribal knowledge, moving from individuals knowing how things get done, to actually creating processes and procedures. Another area where AI can help, by the way. And then adding bench strength where you need to add it. So the profitable growth strategy includes having enough reserves, having enough investment where you can add the people, the function, the horsepower, the bandwidth before you need it. So that when you get to those fence posts, when you go from 1 million in sales to 5 million in sales, from 5 million in sales to 25 million in sales, that you've got the infrastructure to handle that so that you don't have poor customer service, you don't have poor quality, you don't have liquidity or solvency issues, you don't have strains on working capital. So remember that the best thing that you can do every day is determine where to put your next marginal dollar. So as a business is growing, there's no shortage of opportunities to invest, opportunities to place dollars. Again, I'm in the US, so we can say pounds, we can say euros, we can interpret any other. I don't mean to be
Great
so
British pounds.
yeah, I don't mean to be so US centric. It's just the place that I play. I apologize to the international audience. But substitute your currency of choice. But your next marginal unit of currency, where's the best place to place it? If it can be placed 10 different places, your job as a manager, as an owner, as part of the management team, it's to place it in the one best place to leverage. Where can I get a 20 times return on investment instead of a 2 times return on investment? And so often as you're growing, there's a tendency to either spread that unit of currency across everything, 10% to 10 different things, or there's a tendency to place it where we've done it in the past, or there's a tendency to place it wherever someone consumes it first. So we think a guided plan to always be thinking of that next marginal unit, the next marginal decision I make. What's the best one? Has nothing to do with the past ones. Any decision you made up to that point is a sunk cost. Any dollar, any unit of currency that you put in the past, it's a sunk cost. Just because I put $1 million in opening a warehouse doesn't mean my next marginal dollar needs to go towards a warehouse. Maybe
Mhm.
maybe that was a wrong decision, and now I need to start looking for a third party logistics person, third party logistics company. So put that dollar towards a third party logistics. Just because you have a warehouse doesn't mean in the future you won't need additional capacity in a different way. So I think those are the things that really matter when you're scaling a business is always keeping aware of those efficiencies. Just because we were profitable last month doesn't mean we can't be more profitable this month.
Mm. I appreciate your level of analysis, in terms of breaking down this solutions to the most simplicity of forms, right? And of course, it's very, very important that the explanations and of course instructions and narratives that we provide to business owners, entrepreneurs are as simple as possible in order for them to be able to execute them, to implement them uh, in the best way possible, right? And I just was taken, would I say, back to my experience in public accounting practice. Working with two of the big four accounting firms, they always say that we adopt a risk-based approach to audits. Keyword, a risk-based approach. And of course, a very, very important part of the risk assessment process is evaluating the internal control procedures within an entity. Sometimes we even do controls testing. And of course, in cases wherein you're not, testing the controls, you need to go heavy on the substantive testing. So that being said, I have been able to notice that there have been situations wherein a business would have a fantastic business model, but something that would crush it is typically poor controls. And when you give advice to these business owners, they always, like you say, trust their traditional methods. I call it native intelligence, right? Yeah, you're very intelligent, fantastic, a founder, but they tend to undermine the importance of internal control systems, right? That is systems that are put in place, that are instituted by management to ensure that the assets, in that entity are properly safeguarded. And of course, the operations are actually effective and of course efficient. So why is that? Why do these, business owners undermine the importance of internal controls?
I don't think they understand internal controls. They don't understand the need for them. But B, I think more importantly, historically that's come at a cost. Usually it means adding labor to create internal controls. To create a check and balance system requires two steps. Just a check with no balance requires one step. So historically, they've looked at it as adding overhead, adding cost. Accounting is a cost center. Accounting costs me money. I do accounting because I have to do it. But the reality is,
The reality is what I have something to chip in, but then I'm going to wait for you to finish that narrative.
you can chip in if you want.
No,
Go
no,
ahead.
I
Okay.
want you. The reality. I love reality.
So, everything we've been talking about today, I think, and to be honest, I'm a long time away from auditing, so I appreciate you bringing those things back into the forefront of my brain.
Oh wow, you're welcome.
You actually bring up a really good point because everything we've been talking about today of increased granularity, everything that we've been talking about with setting targets and understanding all about why we made it or didn't make it, it all supports internal control. In fact, it's an element of internal control. So if you estimate and you reach it, chances are everything went well. So that by itself is an internal control check, if you will. And as a way of de-risking, if you have your auditor's hat on, what's the thing that gives you the most comfort? Maybe not the most comfort, but what's one element that gives you that adds to your comfort when you're doing your testing? It's data. It's granular data. It's repeatable data. It's historical data. It's all
And
of
of course,
that.
the reliability and the integrity of that data.
Correct. And if you're using data to make better decisions, you're going to want to have data integrity. You're going to want to have data reliability because
Uh-huh.
who wants to go through all this process of analyzing and making decisions and doing all this with data that doesn't work? Naturally, you're going to get the data better. You're not going to do it because of internal controls. You're going to do it because I want to make better decisions. So I think they parallel one another. We're talking about de-risking decision making, which naturally de-risks the results of the financials. It just has to. So you bring up a very interesting point, very interesting. And again, the more data that we have, the more we can turn AI tools loose on it to understand that risk as well, to find patterns that humans have a hard time seeing. So I'm gonna think a lot more about that one. Again, I told you I was curious. Now my curiosity is focused on the relationship between better granular decision making and internal controls. It might just be something that naturally happens. You might get internal controls as a natural result of doing this process.
Okay, interested. And of course, I'm really happy that, I am privileged to increase your level of curiosity. But then there's something I want to add. Uh, in my experience as a Big Four auditor, two major risks that we tend to focus on, in the course of our audits are the risks of management override of controls and the risk of uh, revenue recognition. So those are two major risks: management override of controls, and of course, revenue recognition. But then, why is it that even when management have been able to institute, these controls, right,
Mhm.
they still override them by themselves? And of course, you know that no auditor in this world can, audit override of controls. Basically, it's a collusion. And of course, how, except you're psychic. So why do we have these issues?
Because we're all human, because we have, you know, pressures, because we have differing incentives, differing things. So I think that it's a very good question. I'm not sure I have a very good answer, but I think that we're all humans, that we all put our own spin on things, that we take our historical intuition, or our historical knowledge, our historical lens, and we look at the process, the data, everything through those lenses. So that's where collaboration helps. That's where discussion helps. That's where, more minds meeting, more of the wisdom of crowds, if you will. That's where the more you can coalesce around an objective rather than determining an objective as a sole individual. It becomes a little more philosophical than we're probably ready for on this, but I don't know that I have a very good answer to that. But those are my thoughts.
Okay, for me, I very much associated with the fraud triangle. You must have heard of the fraud triangle. That is, the reasons behind individuals perpetrating fraud in organizations. And of course, the fraud triangle looks at the opportunity, the incentive, and the rationalization. So basically, opportunity comes by way of weak internal controls, poor tone at the top, inadequate, accounting policies, but then when it comes to incentives, management, for example, might want to increase, revenue because their bonuses are tied to the revenue numbers or the profit numbers. So they definitely have that incentive to push up the numbers, and of course they want to impress the investors, they want to impress the analysts, and of course for their personal uh ego, right? Everybody wants to look good, wants the numbers to look good. So hence, we have a lot of window dressing, in public companies, right? And of course, the rationalization, everybody thinks other people do these things. So the competitors are doing it. So, and of course, you have disgruntled employees as well, right? They feel like the upper management, is doing it, they feel disgruntled, maybe they're treated wrongly. And of course, for some people, they think there's no other solution. Right. So I think for me, I very, very much associated with the four triangle. So the four triangle basically is that framework that helps to summarize it, right? The opportunities, the incentive, and the rationalization. But then I think if the opportunity aspect is broken, you won't be able to have, the connection of that triangle, and hence the importance of internal controls. Because if you don't have the internal controls, right, the deficiencies in the internal controls is what leads to the opportunities for these things to happen, especially fraud.
So two thoughts. Number one, again, if you're looking at granular data, the ability of fraud to exist becomes much less, because you're not just, I think fraud, let me restate it. Fraud thrives in averages,
Hmm.
and it dies in details.
Hmm.
So if I'm looking at all of my customers and analyzing them compared to all my items, if there's a false customer, which is, I think, usually I don't want this to be a primer on fraud, but step number one is to create a fake customer. Step number two is to create a fake vendor. Step number three, there's just certain steps that you take. If you're looking at granular across all of your vendors and all of your customers and comparing the performance, like that, you're going to find telltale signs. You're going to say, well, who's the sales rep for this person? Why is the sales rep someone in accounting? Right? That's, like you're naturally going to find where there's anomalies. And again, fraud thrives in anomalies and averages. So I think that there's no way to get rid of fraud, but there's a way to mitigate it. So I think the two ways to mitigate it are better internal controls, which naturally come from more granularity. So if you're going to get, by looking at more granularity, if you're going to get better controls and better decision making, why not do it? So let's just assume you've done that. The other one's culture. Fraud thrives in, like you mentioned before, in some level of
The tone at the top, very important.
the tone at the top. So we deal with a lot of sales driven organizations where sales rules all. But there's other organizations that are efficiency oriented. They're engineering oriented, where engineering rules all, R&D rules all. So find out what the character at the top looks like. So if someone is very sales driven, then if they're going to fudge the numbers, they'll probably do it with sales. They probably won't do it with operations. They probably won't do it with R&D. They'll do it in an area where their background is, where they understand it. So that's one. But I just think culture. If culture eats strategy for breakfast, the corollary must be it starves fraud. So usually fraud is known by others in the organization, and they choose not to say anything about it. Rarely is fraud all by itself. And if there's a culture of openness and a culture of sharing and a culture of questioning, then fraud can't survive because someone's going to ask a question about these anomalous transactions. And someone's not going to be happy with the answer of no answer.
Yeah, because oftentimes there has to be collusion for these things to happen.
Correct.
And I think I would just cheapen the COSO framework, when it comes to controls. So COSO is the Committee of Sponsoring Organizations. And of course, they developed a widely used framework for internal controls, and it includes 5 components. The number 1 component is the control environment. Number 2 is risk assessment. Number 3 is control activities. Number 4 is information and communication. And of course, number 5 is monitoring. So if these, are components are well instituted within an organization, you would be having a strong control environment in that organization. But delving away from controls, let's talk about investing and, of course, reinvesting. So how should business owners balance the reinvesting in their business versus paying themselves and their team?
Difficult concept. I think it goes back to that marginal unit of currency, that marginal investment concept. So it's a balance, right? The business owner certainly deserves to have reward for all the risks they put into play. We feel that there should be a strong element of variable compensation to everyone in the organization. We feel that performance and how you measure performance is very important. Unintended consequences of KPIs is another topic we could talk about for an hour or so.
That's another podcast on its own.
Yep. So, be careful with applying these things. But we think information and success should be shared throughout the organization, and success can be measured in praise, can be measured in recognition, can be measured in money. There's many different ways to measure it. Oftentimes we find the smaller business owner is at the end of the day getting somewhere between 3 and 10% return on their investment. Their net income is 2.5%, 5%, 7%, -4, +10. It's in this range around 0. And we ask the question, why not just put all your money into a risk-free bank and get a guaranteed 4, 5, 6% return? Why are you doing all this work for that very, very small risk premium? So those are the conversations we have around that. Again, we think everybody in the organization should have access to the information that helps them do their jobs better and recognition for doing a job better. So that's variable compensation usually. And again, there's another hour we could spend on compensation plans. But you just start doing some of these things and get better at them. Share the good news, share the bad news, celebrate the good stuff, work on the bad stuff, transparency, a culture of constant improvement, a culture of it's okay to make a mistake. A lot of times, people hide their mistakes and it compounds things. So, the business is an organism. It's a living, breathing, I won't say maybe breathing, but it's a living organism. It grows and contracts as the sum total of all the decisions and all the energy that all of your employees and customers and suppliers put into it. And so if you focus on those things, then much like the body, it'll fix itself. It'll repair itself. Everyone wants to do a good job. Customers want to buy more. Vendors want to sell you a better product. To the extent we get in the way of that with business, with policies, with people, with culture, with all the things, all the thousands of individual things that happen in an organism of business, to the extent we get in the way of that, it's at the business's peril. It's at our peril. So all the things we're talking about, I think, help you make the organization more aligned. It helps you make the organization more cohesive. It helps you get information out into the organization, and it helps you celebrate the wins and work hard on the losses.
Very, very true. So at what stage should a business consider hiring a CFO or a fractional CFO like yourself?
Whenever their ability to understand the numbers outstrips their need to understand the numbers. So if your business doesn't change much, if it's just kind of cruising along, there's not much that a CFO can do. But if you want to grow your business, if you want to take some more risk, if you want to invest, you need a partner in understanding the elements of those things. You need someone to bounce your ideas against. So I would say whenever you're up for increasing risk in your organization, up for increasing growth in your organization, up for increasing profitability in your organization, get a partner. Get someone that can bring another perspective to it. Don't do it alone. And we think a fractional is a good way to go because you don't need it full time. You don't need it every day of every minute of every hour of every business day. You need it a few times a month. You need it a lot for a month or two, and then somewhat for a while, and then just very little. It's variable. So we think the fractional model works very, very well for the first foray into finance.
Yeah, and that's actually very, very true. And of course, it makes for efficiency, basically. So we are nearing the end of this session, and I'm going to go through some rapid fire questions with you. So you just give a short answer to these questions. Are you ready to rumble?
You got it.
Okay, so number one is, can you name one book or one resource that every business owner should read about finance?
I'm going to say Atomic Habits. It's not about finance. It's about getting better at 1% at a time. Atomic Habits, I think, is the best book anyone can read, including business owners. But if you wanted it to be finance, I'm going to say Ray Dalio wrote a big book on, I can't think of the name of it off the top of my head, but Ray was instrumental at Google in creating KPIs and all of that. So anything by Ray Dalio would be probably where I'd start for finance with those KPIs.
Okay, but your top choice is going to be Atomic Habits by James Clear.
You got it, Mr. Clear.
Okay.
Get
Okay.
better 1% at a time.
Okay, and number two question is, what's the biggest financial myth that needs to be debunked?
All sales are profitable.
All sales are profitable. Yeah, that's true. Not all sales are profitable. Very, very true. And number three, financial habits that every business should implement today.
Estimate and measure against your differences.
Hmm, estimate and measure against your differences. Okay, I think the last one I have for you. If you could give just one piece of advice to a CEO struggling with finances, what would it be?
Keep asking questions. There's no stupid question. There's no question that shouldn't be asked. If you don't understand something, it's not because you're not smart. It's because the person explaining it to you is not doing a good enough job. So don't
Hmm.
stop. Don't stop until you get the right answer, get a sufficient answer. It works for auditors as well.
Auditors, we ask probing questions. It's all a very big part of our training, asking probing questions. Definitely, we'd love to do that. I think I'm going to add one out of curiosity. If you were to go on a coffee date with any historical figure, who would it be and why?
Einstein.
Wow.
Einstein.
Why Einstein?
Because there's one quote from Einstein that filters through everything we do at Insightful Partners. Einstein said that if he had 1 hour to work on a problem, he would spend 55 minutes defining the problem and 5 minutes solving it. And I think in finance, we go right to solution. We go right to our toolkit. We go right to a spreadsheet. We go right to an answer. We feel like we have to give that answer. And in reality, the initial question is rarely the right question. So 55 minutes of defining the problem and 5 minutes solving it.
Oh wow, I like that. I like that. It reminds me of when I was writing my ACA exams, right? So basically, you had 3 hours for the exams. So basically, what I used to do was I spend the first 15 minutes strategizing, and I think, yeah, when I was writing the exams, there were questions, there were sections, that you needed to pick maybe 2 out of 3 questions or one
Yep.
out of three. So
Yep.
basically, I analyze and like, okay, what's my knowledge base? If I know all of them, I think, okay, which one is going to score me the most points, especially the ones that are computational based. They are more objective than subjective in nature. So I'll pick that one. I'll probably break it down and say, okay, this is
Yep.
what I'm going to put here. And of course, I just do my annotations across the question paper before starting the the writing
Yep.
proper. And of course, I saw that it really did well for me and I was acing the exams. So strategy is actually very, very, very key in everything that we do in life. Even this podcast, before starting the podcast, I was doing my research for over 1 year before I started. So basically, strategy is very important. I was asking questions to different content creators. And of course, we're happy we've been able to come this far. And of course, it's hard to say goodbye because you have been very, very insightful, to say the least. You've been very, very insightful. And of course, I am very grateful. But where can the audience actually connect with you? Where can they get to connect with your body of work? And of
Two
course,
places. Yeah, two places. Insightfulpartners.com. Insightfulpartners.com, or hit me up
yeah,
on LinkedIn.
that is going to be in the description.
Yep. Hit me up on LinkedIn. Ken LaCroix on LinkedIn. Love to connect with you. Love to have conversations. You can tell I don't shy away from any conversations. So let's have more of them.
Okay, definitely. And of course, we've had a number of guests who have made multiple appearances on this show, and we would like you to be one of them, of course. There's
It
a
would be an
whole lot.
honor. It would be an honor. That
There's
would
a
be an honor.
whole lot we need to discuss. And of course, if you were to give, business owners one takeaway, one key advice before you leave, what would that be? And do you have anybody you would like to give a shout out to before you leave as well?
Business owners, be curious. Always be asking questions. Be curious. Curiosity will lead you down a wonderful path.
Well, they say curiosity killed the cat.
I don't think so. I really don't. Not in terms of finance. Not here. Not in our domain. And then just a thank you to all of the CEOs and presidents that I've presented financials to in my career before I was a consultant. You forced me to present the numbers in a way that made sense, in a way that they could understand them, and to do it very quickly and very efficiently. So those are the toolkits that I bring to the consulting world. But each and every one of you over every single month, meeting, quarter, year, forced me to get better at that. And I thank all of you for guiding me down that path. It wasn't always fun, and it wasn't always neat and tidy, but it was always impactful. So thank you to all of them. I have tremendous respect for business owners and people that put their livelihoods, lives, families, and everything on the line. So I think in finance, servant leadership works very, very well. So I consider finance to be a great place to practice servant leadership and help the rest of the organization understand the business through the finance lens.
Wow, that is actually well put together. And of course, you align very, very much with my personal philosophies. I always say the greatest leaders in life have been servant leaders, and I love the concept and the opportunity of being a servant leader. Jesus Christ was a servant leader. Muhammad was a servant leader. Mahatma Gandhi, servant leader. Think about,
A
the
common theme
great
there, a real
people.
common theme.
It is just a common theme. And I myself, I'm a servant leader. You can are a servant leader, so it's
We
just
try.
beautiful. It is beautiful, the art of being a servant leader. And of course, my tremendous respect also goes out to you, Ken LaCroix, and my gratitude goes to you. Love, respect, and of course, salute to you. Thank you very much for your time today. I am very grateful. And of course, I look forward to speaking with you very, very soon. Please put time, in my calendar at your convenience for our
We
next
will.
session.
We will, my
And
friend. We will. We will.
yeah, thank you. For our audience, if you guys have come this far, what are you doing? Come and go hit the like button, subscribe, comments. Yeah, please drop questions for the next episode we can. Curiosity did not kill the cat. And of course, curiosity will not kill the Ken. So please, drop your questions for Ken. And of course, I appreciate you guys. I appreciate the support, the love, and of course, let's keep it flowing. Let us share the content. Share it with your friends, your foes, your family, your ex-boyfriends, ex-girlfriends, everybody, within your network and of course outside of your network. Thank you very much, guys. For me, it is love and respect, and of course, goodbye.